Hey guys, welcome to the weekend update. And we are recording this as the Wimbledon final is going on. So hopefully, as I finish this video, Alcaraz, a fellow Spaniard, will be up 2 sets to 1. Anyway, getting into the report today. Now, I wanted to do something similar to last week. Last week, of course, we went through some slides from that Macro Voices podcast. I wanted to do this again today, basically because the guest was Darius Dale, which is someone who obviously I have a lot of respect for in terms of macro. He makes some very good points in general. I think he has been a little bit off, really. I mean, he didn't quite. I wouldn't say he called this rally, but he actually came on the show today to kind of try and explain why the rally has happened and kind of what he sees moving forward in terms of the economy. And basically, as we can see here, he talks a little bit about basically why the economy has been so resilient and gives us I believe it's like 5 6 reasons. So number one, as we can see here, so again, these are slides provided in the from the podcast. If you go ahead and subscribe at their website, so please go ahead and check that out. So what we can see here is a record cash on household balance sheets, and this kind of interestingly goes a little bit against kind of the data that I've been also looking at recently. Those charts where people are talking about excess savings really starting to drain down. And that really doesn't coincide with what Darius Dale is seeing here in the data. I guess oftentimes, data can be manipulated, interpreted in different ways. So anyway, what is interesting here is that, we can see here the first graph, US household checkable deposits and currency basically at all-time highs, checkable deposits and currency as a percentage of total assets also kind of well above the trend, kind of into the levels we were at, like, back in the 60s, even, 50s, 60s, which of course were been good years for the US economy. And yeah, similar if we look at US household debt to personal income. So again, that ratio is really showing that in terms of balance sheet, the households are very resilient. So there's only so much that an economic downturn can do to these households at this point. They're still very comfortable. Now, number two is also record cash on corporate balance sheets. And again, interestingly, this does also conflict a little bit with what I wrote about in my last article on Seeking Alpha, where we were actually looking at CLOs, which were credit loan obligations, kind of like the CDOs, and kind of that I was kind of flirting with the idea that we could see a big contraction in corporate debt, especially moving into 2025 when those maturities start approaching. But nonetheless, like Darius points out here, there's also record cash on balance sheets. Yeah, so we can see here, same way, checkable deposits and currency, pretty near the highs here. US corporate checkable deposits and currency as a percentage of total assets, a bit lower than back in the 60s, but also pretty much near record highs, at least in terms of the last 20 years. So this has been obviously coming up basically since that crisis in 2008. Now, another metric he pulls up here is key measures of private sector income and wealth have outpaced inflation since the start of the pandemic. Okay, so as we can see here, for example, US household assets, cash, US household net worth, US corporate assets in black, nominal employee compensation, and US CPI, and then the CPI here at the bottom. And this kind of is reflective a little bit of what we talked about last week with the slides provided by Juliette Leclerc, that was her name, where she basically talked about how that's kind of created a wealth effect, right? Because the wages and the inflation has been kind of tapering off, while actual wages and stuff has been continuing to grow, creating kind of a increase in real earnings, and this is kind of also reflected here. Then he also talks about limited credit cycle vulnerabilities, also similar to stuff I mentioned before. The idea being here that, for example, if we look at credit to not United States credit to private non-financial sector debt, basically as a percentage of GDP, and the debt service ratio. For example, we can see that the debt service ratio is basically quite strong right here, and that these debt levels really, as a percent of GDP, have actually been trending down. So really kind of showing that that resilience in the credit cycle, which is also reflected in um, mortgages. Yeah. So we have the in blue here the U.S. effective mortgage rate on debt outstanding, and as we can see, this is basically, this tracks pretty much the 30-year fixed national average, and now of course the 30-year fixed national average has spiked up, right? And this is basically, let's say, new mortgages coming out, really hitting that 7% level, but effective mortgage rates aren't there, right? And this we can see that big spread, let's say, reflected here. So the mortgages haven't caught up to those higher rates. Now we can also see here limited exposure to the volatility manufacturing sector. This is another point he makes. And we can see here the manufacturing as a share of nominal GDP has been basically trending down, and manufacturing share of total non-farm payrolls also has been trending down. So less effects from that as compared to maybe previous recessions. And then labor holding is another one, which again was mentioned by Juliet. The idea that there's basically a tight labor market, and companies aren't trying to let people go. And we can see that gross domestic income has actually risen above the pre-COVID trend here. So all these things really coming in to provide a much more resilient backdrop to the U.S. economy. And ultimately, Darius Dale basically pointing out that his basic assessment of the economy is that he talks about the need for a phase 2 credit crunch, right? That kind of event that we can think of back in, for example, 2019 and 2008, right? An actual kind of deflationary bust, which we haven't really seen yet, and he still predicts that will happen. But of course, it's going to keep pushing back that prognostic into maybe at this point Q1 of 2024 even. And in the meantime, of course, that doesn't mean that the markets are going to come down with that. There's other things to take into consideration there when it comes to positioning and how people are reacting. And in fact, in that regard, it's interesting to see, for example, right, this has been the case for some time now, that domestic liquidity measures have not been going in line with the rising equity markets, right? So, liquidity, of course, is a big driver of markets. And, we talked back a few weeks ago about what the TGA would do and all the effects of, liquidity in terms of the reverse repo market, how China could be affecting liquidity. But the bottom line is, and it has been for a while, that if we actually look, liquidity has been trending down while equity valuations have been trending up. The S&P has been trending up. Okay, so what is the reason for this disconnect? And one of them, actually, and I don't have the chart right here, but basically talks about the fact that there's basically essentially been a short squeeze, right? So a lot of shorts have been squeezed up, and that's kind of, to an extent, what's moved the markets to this level, without necessarily being supported by the liquidity. But of course, those that resilient economy, together with the position in which forced a lot of shorts to cover, has really helped take up these S&P and these stocks up to these levels. So moving forward, we still expect. I still expect the rally to continue to an extent. I do think, again, that the way I'm seeing things now, a lot of people who were very bearish even 2-3 weeks ago are now starting to turn bullish, which is really, really making me very wary of the outlook, especially the more immediate outlook. I think there's just too many people now positioned to the upside, and just like when there were too many people positioned to the downside, we got that rally. I do, maybe now it's time for a long squeeze. Now the other interesting thing the other interesting kind of, let's say, macro variable that has really been making headlines, at least, or under my radar, is of course that that depreciation in the dollar, that real kind of breakdown we saw in the dollar in recent days, and how that affects our outlook. So we did get that breakout. In terms of a technical analysis, we can see that the dollar broke out from this triangle and kind of went down, and we could see here a wave 3, right? In fact, we could actually even identify here, there's the 1, 2, 3. And in this wave 3, we have a 1, 2 kind of setup, and now we've really broken down in that aggressive wave 3. So very interesting to see that play out kind of as we were expecting. And, the dollar, of course, the dollar depreciation helping, lift assets like oil and commodities. Now, I do think that, obviously we might have to get a bit of a retracement here at some point. Also, especially as we'll see later, US oil, for example, oil is starting to hit some major moving averages, some resistance up top. So it'll be interesting to see how this plays out. But overall, this breakdown is something that we've been looking for. It's something that's kind of predicted by the fundamentals, right? So if we look here, Andreas Larson, another great macro commentator, talks here about how the euro, in terms of the euro versus the dollar, why we're kind of seeing that separation. One reason being here relative growth that has been more supportive in euro, since the fall of 2022. And one of the reasons for that is, of course, the quote unquote impulse from falling energy prices, right? Which is now tapering off, okay? And we're seeing that happen, since September, October. So that growth that Europe was enjoying, that excess growth is now starting to taper off. We can see that spread is going down. And in that regard, we can also see that the core inflation spreads, which have historically led the euro-US dollar by 4 or 5 months, are starting to basically show us that, we really should be looking at a much more higher a higher euro in terms of dollars, and kind of, reinforcing our view of the technical analysis, which is really that, the DXY, the dollar index, is heading lower in the coming days. And, before we move on to the charts and look at some of the technical analysis, I'd like to talk a little bit about, of course, the ruling in the XRP case that, has really kind of pushed up altcoins. Coinbase, of course, JP Morgan coming out here saying Ripple's XRP ruling is a win for Coinbase. Well, no duh. I mean, so basically we got a ruling in the XRP case where the judge was talking about how the initial offering of XRP could be considered a sale of an unregistered security, while the secondary offering, let's say, so the offering made by Coinbase, or the sales made in exchanges, would not qualify as sales of unregistered securities. And that sets, of course, a precedent that kind of tears down the whole lawsuit that the SEC had against Coinbase, right? So Coinbase, Binance as well were done for the sale of unregistered securities. They listed stuff like Cardano, Solana, and of course, if XRP's sales on exchanges do not qualify, according to this case, according to this judge at least, then there's a very strong precedent there to say, Cardano, Solana, what are you talking about? I mean, Coinbase is doing nothing wrong here. They're just selling kind of on the secondary market. This has nothing, there's no issue with that. So let's talk a little bit about, so with that said, let's move in to talk about Coinbase, right? So looking at the Coinbase chart, we can see, and I've been bullish on Coinbase since the lows, and especially on Seeking Alpha, talked about buying here, down here at the $45 level. Why? Well, pretty simple. If we look at the retracement levels, right, of our wave 1, we can see we actually stopped almost exactly at the 61.8% retracement. I mean, pretty much exactly at that level. Okay, so these fib levels sometimes work, so definitely something to look at and add into your trading if you're not using these levels, because that really helped me and my subscribers get a very good position here. And now basically what my analysis is telling me is that we're near a top here, at least a top in a wave 1. We're definitely starting to see some divergence. This is a bit more clear maybe on the 4-hour chart, but we can see here that we really reached the top in the RSI here, and we haven't really managed to break above that. We started to see we saw this red candle. So after reaching about almost 120, or more like 116, we really started to turn down now. I mean, it's still a bit early to tell, but this to me looks like it could be the top in an initial wave 1 that eventually takes us up here, right? This would be the target more or less for our wave 3, around $247 maybe. based on our analysis here. Sorry, so this is our wave 1, 2. So again, if we look at the fib level, so we measure that wave 1 and measuring from the bottom of 2, we see that the 1.618 extension takes us to about 242. So that is pretty much the level that we're looking at in terms of the target for the next move. But before that, we could see a significant retracement. Of course, this area here, if we look at the so if we measure this wave 1, of course, we can see the 61.8% retracement takes us down to about 64. And, basically looking at the visible range volume profile here, we can see that that's basically, especially if we zoom into the more recent action, this is basically, as we can see, this area here will act as very strong support. And we also have the moving averages here on the 4-hour, also on the daily. So the daily 50-day moving average coming in exactly at that 61.8. So again, right now, my vision is that we could see a pullback around here. And this pretty much coincides with a lot of the charts and just my general outlook. I mean, we've gone so far in stocks and, also crypto at this point has really caught up. So we need to see that pullback, more so in stocks, I think, at this point as well. But, if we look at anything, for example, Marathon, I actually sold some Marathon, and I think that's and that's kind of what the charts are just telling me right now. I can, in a similar way, kind of really seeing that RSI, first of all, of course, very overbought, and starting to see that divergence, really, that kind of loss in the momentum, really, where the RSI is really struggling to make higher highs. I mean, the RSI made a high up here, and it's begun to really turn down. So, price goes up, RSI fails to, break that high. That is a bearish divergence. Now, this outlook pretty much coincides as well with what we're looking at for Bitcoin. Okay, so if we look at Bitcoin, my current count would be something along the lines of this. Now, there's different ways of counting this. I mean, there's even the possibility that this is still a wave 4, right? We can't totally discard that. That is definitely not my primary scenario right now. If I had to guess, I think there's an argument to be made that this was all a wave 1 and this was a wave 2. Now, we could also talk about this being a 1, 2, 3, 4, and this being the end of our wave 5. Okay, so I'm kind of in between those two counts right now. But I do also see the possibility of this being all part of the wave 1 and this just being part of the wave 2. But in either case, if we zoom into the more recent action, what we can see is that we got that impulse from the recent lows down here at about 24,000. We got that big impulse, and with the final high we got on Thursday, I believe it was, or Friday. I think that kind of completes our 5-wave structure here. It's very messy, that's for sure. And ultimately, we're still kind of trading in this range, and it's very hard to determine what's going to happen. But we should basically, based on the Elliott wave, get a retracement and back into these levels. And again, just basically retesting, first of all, that support provided by the visible range volume profile. We have the 50% retracement going on there. And also on the daily, we have for example, the 50-day moving average coming in there to offer some support. So really, this area here, important area of support. Now let's have a look at the Nasdaq as well. And of course, the Nasdaq, like I said, basically heading into that 16,000 point range. And this is where we're heading right now, right? So if we actually look at this wave 1 and measure from the bottom of the wave 2, basically I'm looking for the 1.618 extension for this wave 3, and we're just about to tap that just below 15,000. Okay, so 16,000 is really the upper level of the targets here. So again, I believe we are very near the top, and really, I mean, it coincides with just everyone I see now just turning bullish, saying, "Oh yeah, no, I was bullish all along." Well, if you were bullish all along, suddenly you've turned. I mean, you weren't bullish all along, and now that you are bullish, it's kind of making me think that we're going to sell off. And again, I think that it's not like going to be a huge sell-off, TBD, but rather that we're going to see a wave for pullback, again, retesting key levels of support, moving averages, etc., etc. This is kind of my target, of the wave 4 on SPX at least, maybe testing out 14,000. So significant sell-off. I mean, significant-ish, let's say. I mean, something like about 10, 15% drawdown maybe if we go up from about here. Nice 50% sell-off, just enough to really get people wondering what's going on again, shake some of the weak hands out of their positions. Yeah, that's kind of my outlook on the MDX. Of course, very different from kind of my outlook on oil and some of the commodities, which in my opinion are really kind of setting out for higher, right? In fact, look at oil, broke above the daily 200-day moving average here. Gave us a very strong move, and this also, of course, coincides with our view that the dollar is breaking down. Yeah? So the dollar breaking down, I mean, it is not necessarily bad for equities, but the relationships that are stronger here would be, of course, weaker dollar, better commodities, and to an extent, more even more bullish for crypto and those kind of assets. So ultimately, you can see here on my kind of larger degree count that basically this is what I'm expecting from oil now, is at least, kind of a one final leg up in this wave 5 to basically maybe even 130, 120. So even above the highs we made before, right? Now, of course, gold and silver especially really started to move up, and kind of, I did add some silver back here. Now, I was thinking about getting more aggressive if we touch that that kind of trend line here, but we didn't. Well, we didn't get a chance to get more aggressive, but we did benefit from some well-timed positioning right around this area here, and this breakout is pretty undeniable in its strength. And of course, not the time to chase this now. If you're looking to get aggressive, that boat has sailed. Unfortunately, it hurts me to. I kind of wish I could have, been a bit more aggressive, back at these levels, but that's the name of the game. Sometimes you miss some entries, and that's all right. So silver, of course, giving us what looks to be here like pretty convincing impulse. I mean, at the very least, in terms of the Elliott wave count, we have a 1, 2, 3, 4, 5, I think. So kind of that idea that we're going to get to maybe near these highs from before, and we are actually now at an important resistance level. So I do expect a bit of a pullback now, and yeah, if we get a pullback here, we could try and become a bit more aggressive here even. But ultimately, I would see this wave 5 here, and then of course we'd also need yet another pullback in a wave 2. So again, I think this area around 22, 21 now after the breakout will be kind of retested. I expect us to maybe stay here for a little bit before we break out even more to the upside, right, to really complete that wave 3, which should lead us somewhere around $30 over here. And just to wrap up, I wanted to talk about Tesla because, again, my view right now is that we are in need of a pullback. That, makes sense when it comes to sentiment, and it makes sense when it comes to the technicals of some of the big caps that have really been leading the rally in recent months, right? And so I looked at something like the Tesla chart, and of course Tesla is reporting earnings on Tuesday after the bell, or Wednesday after the bell. So Wednesday after market close, we will be getting those Tesla results. And basically, I think that people are going to be expecting kind of reverse situation as last earnings, right? People were kind of very very negative about earnings in general, and kind of expecting bad things. And now I think we can expect kind of the opposite, right? Where expectations now, especially with Tesla and a lot of other companies, are very high, and I think we're setting ourselves up for some disappointment. And from a technical perspective, this kind of $300 area is really where I've been expecting us to kind of land, for the past few weeks. So basically, I can see here, I would call this like an ABC structure, really. So, and if we measure the length of wave A, and right now we're pretty much approaching, actually not quite, sorry, my bad. We're actually a little bit far away, where A would equal C. So we're actually a bit far away from that at the moment. But, we're getting into an important level of resistance, of course, psychologically, $300 level. This is, of course, the previous high we had here, right? And of course, we can see a previous important area of trade, yeah, around here and here. So just getting near that reversal, and again, pointing out to those divergences happening here. So obviously RSI forming a divergence here. So I think again Tesla looking like it should really take a turn. The only one of the better looking stocks though is Google, right? Google I actually see as being needing to complete a wave 5, and this could again I think still, I mean, we still have a little bit to go up. I think if we look at my targets for the SPX and the NDX, 16,000 I think for the SPX. I reviewed that in the last video. I'm not going to review that now. But we're looking at about 4,600, even 4,700. And Google is one where I do actually see a bit more of a convincing story in terms of the structure, where I could see us, going into a wave 5 before a pullback. So Google, we got a good retracement here in a wave 4 that actually we can see, tapped here the 21.4% retracement. So I would expect Google to push up a little bit higher into this area. Just, I mean, this kind of makes sense. Google really has been a little bit behind the other stocks in terms of returns. And again, kind of we can see again this area of resistance starting to near the highs, but so kind of we could see a bit of a double top really if we think about it. And similarly in indexes like the SPX and stuff, kind of seeing that double top and then a sell-off to really kind of cool off this enthusiasm, which is really getting out of hand in the last week. So, that's kind of my outlook for right now. As always, I hope you enjoyed this video and, stay tuned for more.